Some of our clients require financing when purchasing real estate in the Dominican Republic. That's why in today's video, I want to talk in detail about real estate financing in the Dominican Republic. The process of obtaining a mortgage or a line of credit is very similar to that in the US and Canada, but it certainly has its own nuances. It's advisable to submit your loan application in advance, as the process is not quick and can take about a month for purchasing a resale property and up to 2 months if you are financing the purchase of a new development. In recent years, the lending market in the Dominican Republic has been growing very rapidly, and as it grows, the programs and terms for issuing loans are also changing. In the Dominican Republic, as elsewhere, there are several major banks as well as other financial institutions that issue mortgage loans and lines of credit. They have many different programs and varying qualification approaches. To find out precisely which bank offers which specific programs, you will undoubtedly need to spend a significant amount of time. Plus, if you do not speak Spanish, a language barrier often arises, making the process even more challenging. The absolute best and most efficient way is to simply contact us directly. We work with the mortgage company, the lending brokers, which has been operating in the lending market in the Dominican Republic for many years, and we will connect you with one of the company's mortgage brokers. This will save you a lot of time, and most importantly, in the end, you will get financing at the best rate available for your situation. The lending brokers has long-standing, well-established, and extensive relationships with major banks and other prominent financial institutions throughout the Dominican Republic, and they are truly dedicated and highly skilled professionals in their field. They have already helped dozens of our clients obtain financing to purchase real estate in the Dominican Republic. And the very first thing your mortgage broker will do is to conduct your pre-qualification in order to determine which specific bank program is best suited for you. All of this can be done remotely by sending your documents to the mortgage company via email. What documents will you actually need to provide for this process? The very first, of course, is 2 forms of identification. As a rule, these are copies of the first page of your passport and copies of both sides of your driver's license. Next, you will need to provide proof of your income. For Canadians, this is typically the T1 or T2 form. If you own your own business or work as a self-employed individual, this applies to you. A notice of assessment for the previous year will be a good addition, but it is not mandatory. If your primary income comes in the form of a regular salary, you can readily provide a formal letter from your employer and recent pay stubs for the last 2 complete months. You will also need to diligently send your personal and, if applicable, any relevant business bank statements for the last 6 consecutive months to the mortgage company, clearly showing that you are consistently receiving a stable income. Dominican banks do not have access to your Canadian credit history, so you will also be asked to provide an official Equifax credit report, which you will need to request yourself directly from the credit bureau's official website. Within approximately 1 week, the mortgage company will thoroughly review all the documents you have provided and then give you a detailed analysis, specifically which bank, for what exact amount, and at what precise interest rate you can obtain financing. It is important to note that a mortgage company is not the bank that will be lending to you. They work for you, and if necessary, will of course advise you on which additional documents need to be provided, or if anything needs to be changed in your application package so that you can get the best possible loan terms. The decision is then up to you. After you have carefully chosen the bank and the specific terms, the mortgage company then sends your complete set of important documents to the particular bank you have selected. The review of documents at the bank usually takes from 2 to 4 weeks. For new construction properties, the application review process takes a bit longer. If your loan application is approved, you will receive a notification that the bank is ready to close the deal, and all that remains is to agree on the closing date. For future loan servicing, you will need an account with a Dominican bank. It is better to open it in advance. This significantly simplifies the process of obtaining a mortgage loan. I recommend opening 2 accounts, one in Dominican pesos and the other in US dollars. You can also take out a mortgage either in pesos or in US dollars. But honestly, I haven't really heard of foreign buyers specifically taking out loans in the local currency here in this country. Usually they take them in US dollars. Currently, the interest rate for loans in US dollars ranges from 8 to 11%, depending on the bank and program you choose. A loan is possible for up to 80% of the property's value, but to get the best rate, it's usually no more than 70%. The actual closing of the deal takes place right at the bank. You sign the documents for the mortgage on the property you're buying, the bank transfers the money to the seller, and your lawyer finalizes the transaction. In reality, everything is very straightforward, and there are no hidden pitfalls. The financing process for new developments looks a bit different. The thing is, when you buy a new development, the developer themselves offers you an installment payment plan. A standard contract for purchasing a new development involves paying 25% upon signing the contract and 45% during construction in small installments. 3 months before the keys are handed over, the developer notifies you that construction is complete, and only at this point do the banks begin to arrange financing. In other words, the apartment or villa is already almost finished. In 3 months, the transfer of ownership from the developer to you will take place. And, as a rule, by this point you have already paid about 70% of the purchase price. Of course, you can pay the remaining amount yourself and own the property without a mortgage. But if you want to use financing, this is exactly the moment when you should contact the bank. You choose the loan amount yourself. It can be any amount, but it cannot exceed 80% of the purchase price. You can take out the remaining 30% of the price from the bank, which you still owe to the developer, or you can take a larger amount, any amount up to 80% of the property's value. If you choose the second option, then at the closing of the deal, the bank will transfer to the developer the amount you still owe them, and the remaining sum will be deposited into your account, and you are free to do whatever you want with it. Another difference in lending in the Dominican Republic is that mortgage amortization here is not 25 to 30 years, as we are used to in the US and Canada, but 15 to 20 years. Accordingly, the monthly payments are higher, but the returns from short-term rentals here are so incredibly high that if you use the property for yourself for 2 or 3 months each year and then rent it out short-term through a professional management company for the remainder of the time, as a general rule, the substantial rental income will be more than enough to comfortably cover both the mortgage payments and all the property maintenance costs. So even with higher interest rates than in the US or Canada, taking out a loan here is still profitable. After all, with the freed up funds, you can buy a second property in the same way, and so on. This way, in just a few years, you can build an excellent investment portfolio. If, for example, you have completely paid off your property in full with your own personal savings today, but tomorrow you unexpectedly need money, you can always readily go to the bank and obtain the amount you need. Home equity lines of credit are indeed very popular. Their significant advantage is that you can conveniently pay off the credit line at any time and take it out again if necessary. It works exactly the same way as it does in the US and Canada. At the moment, the amount of a home equity line of credit issued in the Dominican Republic cannot exceed 50% of the value of the property used as collateral for the credit line. And finally, I want to note that Dominican banks are very accommodating when it comes to issuing property loans to foreigners. No one is going to scrutinize you under a microscope the way they do in the US or Canada. In fact, Dominican banks simply don't have the capability to do so. For Dominican banks, foreigners buying property in the Dominican Republic are considered creditworthy by default, and loan applicants just need to properly prepare their set of documents. And the mortgage company, the landing brokers, which we work with, does an excellent job. That's all for today. See you again on the channel.